Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is March the 17th, 2023. Happy St. Patrick's Day. It is now 3:38 p.m. Central Time, and we still continue to see a flight to safety because of all of the turmoil in the banking industry. Home loan interest rates are improving, mortgage-backed securities are improving. And let's take a look and see a little bit more about what we've been talking about the last couple of days. We talked about the fact that the banks borrow money back and forth in the billions, sometimes just overnight. And that seems like we might be talking about, maybe we're being a little dramatic. Well, that is not the case. And we can see this actually happening on a day-to-day basis if you really start to pay attention to what is going on. Now, normally, again, when banks are starting to have issues, they go to the Fed. The Fed is who traditionally is going to come in and calm markets because they have essentially unlimited money. So who can you go to if no one wants to let you borrow money? Well, if you have the privilege to go there, if you are a large enough bank, you can go to the Fed. And there are things that they have worked out in order to calm markets, as in this case. Signature Bank fails, Silicon Valley Bank fails, and now First Republic Bank is the next that is really being scrutinized and looked at. So unfortunately, they are taking a massive hit to the stock prices, but the banking industry doesn't want to see other banks fail because it creates contagion. We talked about that yesterday. So if one bank fails, two banks fail, all of a sudden 3, 4, 5, you start to feel like, wait a second, is this going to come to my home? Is my bank going to start to face issues because of the others failing? Are my depositors going to come in and say, hey, I don't know what's going on in the banking industry, but I want all my money and I want it now? If that happens to any bank on a large enough scale, it doesn't matter who you are, you're in trouble. So they never want to see the industry in turmoil. So as First Republic Bank is starting to experience major losses and looking to be the third failure, or the third large failure that we're hearing about, take a look at what is going on. So you look at this article here and it says First Republic shares slide almost 30%. Okay, now take a look at this quick chart. Look at where their stock shares were February 3rd to where they are today. Okay, massive decline, almost just deteriorating right in front of us. And this is happening very, very quickly. Well, the banks are not liking that. They got to put a stop to it. So what do they normally do? They normally go to the Fed. Okay, so the Fed, though, the Fed doesn't want to be everyone's savior. They will if they have to be, but that's not really what they want to do. So oftentimes they will reach out. They'll use their power to reach out to other business leaders and have them come to the table to try to solve their own problems. That's the way it's kind of looked at. Is it, hey, if the banking industry created this problem, the banking industry needs to figure it out. Now the Fed's always there, kind of, backstopping everything that's going on. And everyone kind of at this point knows that they're there. It's changed the dynamic of things. But the Fed gets together with 11 of the largest banks in the United States and says, hey, you got to figure something out. So they come together, and as you see here, these losses of 30% come after. This is after 11 other banks deposited or pledged to deposit $30 billion to bring confidence back into the depositors at First Republic Bank. So you can see we're talking about billions of dollars moving from one hand to the other, moving from one company to the other. Why would a bank want to help another bank? Why wouldn't that bank want to see their competitor go under? Because it's for the wrong reasons. They don't want to see banks fail and create contagion and have a rollover to the next and the next and next, because it eventually will come to their home as well. So how is that affecting home loan interest rates and mortgage-backed securities? Well, this is what's called a flight to safety. We've been talking about that over and over. Take a quick look here at the overall stock market and equities market. The Dow Jones is down 384. The S&P is down 43. The NASDAQ is down 86. Money is moving from the stock market over into the bond market. Look at the mortgage-backed securities, up 41 basis points. Again, another great day. The 10-year Treasury down 13 basis points. Let's take a quick look and see what that looks like on our charts here. Pull up to the mortgage-backed securities chart, and you're going to see that we are now still up in this range, broke above this Fibonacci level, and now guess who we need to face? The 200-day moving average. But we still haven't gotten past this, some sort of psychological barrier here at 101. We just have not been able to butt up against that and get through that invisible barrier there. And here's our 200-day moving average over the top that we need to start fighting with soon so that we can get back to talking about interest rates in the fives. Because again, we're only a couple of months away now from my projection of being at 4.875 by July the 1st. Okay. I'm still saying that can happen. Just keep that in mind. So let's take a look and see where we are right now. Pulling up the interest rates for the Brent Bruce. Here we go. Oh, let me log back in here right quick. So we are going to log back in and take a look and see where we are on our very, very well qualified 30-year fixed conventional home loan. Sorry about this here. Don't know why it logged me out. We're going to jump in there. And again, we were talking about, what was it, 6.5%? And we've been sticking at that 6.5% for some reason, not seeing the benefit that we would expect to see because of the gains in the mortgage-backed security market, because the banks aren't totally sold on the fact that these gains that we have received recently are going to stick. Because if it is a flight to safety and money is flooding over into the bond market for safety, once things settle, the mortgage banks are saying, look, that money is going to move back out and it's going to move back into the equities market. And that makes sense. That probably is going to happen. So this might be somewhat of a flash in the pan that we need to take advantage of and lock some of our transactions in now. Otherwise, what we really need to see is the true improvement to the bond market is the reduction of inflation. And again, we have a big report on Wednesday from the Federal Reserve coming out and talking about what they're going to do with the federal funds rate. And man, oh man, is it going to be interesting. Whether they're going to pause, quarter, half, because there's a lot of different arguments that make sense for that. So let's take a look and see what our scenario looks like here on our Brent Bruce Daily with another 41 basis points, now 42 basis points coming to us in our MBS. Look at that. 6.5% again. 6.5 with a credit of 1,300. Guys, basically what we have seen here is an improvement to our credit, the credit that we get of like $500. But yet we've gone up 100 basis points on our MBS. Why is that? Because the banks aren't sold on the fact that this is going to stick and because they're holding on to some of their profits. But take another look. We always have to look a little bit deeper. If we open this up here, United Wholesale is leading the pack here today. Look at these buy downs. Look at how small the amount is to buy lower interest rates. If you go for less than a point, you are at 5.875. For 0.353, so less than a half of a point, 0.353, you're at 5.999 on a very well qualified 30-year fixed conventional home loan with these parameters. Okay, so you always have to look further into it to see what is really going on. And we shop not only the banks, but the interest rates within those banks. We always are looking for the best scenario, the best program. Make sure that you like, subscribe, and share. And if you do enjoy this information, make sure you watch every day because you can see how volatile it is and how much you're learning about how things really move. And by the way, I always want to let you know, I am a mortgage broker. If you are in the state of California or Tennessee, I don't know why you would not be giving us a call to give you these interest rates for your clients. Give us a call. My information is always down below. I'll talk to you again tomorrow.